We've had covered call ETFs were hot last year. JEPI was huge. Actively managed core ETFs were still big as well. So I don't know. The public, it's hard for me to say that there's a really clear trend right now. I do see money going into equal weight, but it's not an overwhelming amount of money.
No,
it's noticeable. You can see it, but it's not overwhelming. I want to move on and talk about bonds. There's been some signs. ETF bond investors are moving out of the short end of the curve. Maybe you can weigh on this a little. Can you explain why they would be moving out on the short end and what that might imply? Where would they be moving into? Longer end?
It certainly was the story of 2023. You saw a lot of money go into that short end of the curve. These are the ultra short or short-term government ETFs. Certainly money market funds was a huge story. But also we saw a little bit of a change really in the fourth quarter and into this year, where we saw a lot of money start to move out of that short end of the curve into intermediate duration. And you started to see that picture start to emerge where advisors are looking and retail investors are looking to capture or lock in those higher yields and also potentially get some capital appreciation as rates back up. And, they could look to profit as the Fed, starts to ease, assuming, you're anticipating that happening at some point later on this year. And we're starting to see that show up in the pictures and the data that we're looking to see.
So, Todd, is there an argument that can be made? Is there a fixed income discussion as to whether is the market too optimistic about Fed rate cuts and the timing? A lot of advisors have told us they're expecting just 2 or 3 rate cuts. So the consensus is 4 to 6, depending on who you ask. What's it telling us? Is there anything we can see here that the market's telling us?
So that's what's surprising to us. We survey advisors at Verify on an ongoing basis during our webcast, and we ask them what do they expect in 2024 in terms of the number of rate cuts. You're right. The Fed has put out some guidance. The market overall has been talking about 4 to 6. We actually saw the majority of advisors that told us at Verify they're looking for 1 or 2 rate cuts in 2024. So that argues that you should stay relatively short term if you're not going to get rewarded in intermediate term products.
So the point is if the Fed cut rates 6 times in 2024, the longer end would benefit more.
Correct. So TLT is the iShares 20-plus year Treasury ETF. That will get the biggest bang for its buck. Some of the intermediate-term products like VCIT will get some bang for the buck, and the short-term products that were very popular in 2024 will largely tread water or earn a little bit more than their overall income. If we get fewer cuts than the market is expecting, and that even that the Fed is originally guiding to, then you're not getting rewarded for that. You're actually just taking on more risk. Nobody in fixed income wants to take on more risk than they feel is necessary.
Well, I would just add, TLT, which is that 20-plus year duration ETF, Treasury ETF, really was a top flow getter in 2023, even though for the vast majority of that year it was unprofitable. And so you saw a lot of that, positioning start to, occur. But I think a lot of the, investors that we talk to are worried about the reinvestment risk. So Todd's exactly right. You do get, it will tread water or close to it in that environment, but you really have that reinvestment risk if the Fed cuts rates as those yields trend down. And so investors are looking for a way to, capture that or lock in those higher yields.
I can't tell you how many people just message me, and I'm perfectly happy in my money market fund, which is still pulling, what, 4%?
Yeah.
Still?
With no risk, or essentially no risk.
Well, the risk is if it moves quickly, you're not going to get 4%.
Right.
There's no, 1 year from now we're going to get 4% on anything. But they seem very happy with this. I keep telling people, you think that this is something you've signed on to for the rest of your life, and you have not a clue that this could be 3 months from now. This could be 2%.
Right.
Exactly.
And they don't seem to be, that kind of risk doesn't seem to occur to them. That's there. There's no, there's no real. You're not locking in anything when you do that.
Right. It's not a 1 year CD or 1 year T-bill ETF.
And I'm kind of surprised people do that because if you want to lock it in more, a 2-year CD is a much better instrument because you know what you're going to be getting for the next 2 years. They're telling you what you're going to be getting. You have no idea what you're going to be getting in a money market fund, and yet people seem delighted by this.
And not even just the 2-year CDs. We have these products that came from bond blocks and FM that offer you exposure to the single treasury and now even the corporate products with a fixed time horizon as well.
Elsewhere, I see inflows into quality. This is a phrase that I think is vastly overused. Quality basically refers to companies that have strong cash flow, growing their earnings, strong balance sheet. We've used these phrases for 30 years. The academic literature generally indicates that that is one of the factors that tends to outperform. You know, people talk about small cap tends to outperform big cap. Different sizes, small cap tends to outperform big cap overall. Value tends to outperform growth. Quality tends to do a little bit. These are one of these factors that we've seen. So QUAL has had inflows recently. There's a cash flow ETF, the COWS, that's been doing very well. There's a small cap version of that, CAF.
Love the tickers.
CALF, yeah. That's small cap stocks with strong cash flow, right?
Correct. So small cap quality. We're seeing continued interest in these higher quality investments due to market uncertainty, due to earnings uncertainty going forward. And we've seen those products continue to be popular, even though we've seen new competition. Victory Shares launched VFlow and SFlow in the last 6 months. We've seen Amplify offer some of these products as well. This is a hot area to launch products and also to invest in the ETF space.
Quality makes perfect sense to me because, in a sense, that's what you want. You want a company with a strong balance sheet, growing earnings, good cash flow. All of this makes perfect sense. And yet, people still chase the moon. They still chase silly ideas and crazy little ventures or companies that don't make any money and small tech startups that are a long way from making money.
That's exactly right. I mean, quality from a marketing standpoint is exactly what you want and makes a ton of sense. But again, you see the flow picture.
Is it because it's boring? It's basically boring, right? It's sort of like...
I think you could widen that out and say it's really passive to some degree in general. It's boring, but it works. I mean, if you look at even a product in the tech space like, the QQQ, right? That product has been, pretty much a world beater from a performance standpoint. And in that space, it is pretty boring relative to other options, but it works. But you still see investors, attracted to some of the thematics, active, and some other more narrow slices of the industry, despite the numbers.